My name is Mark Polton. I'm a buy and hold real estate investor in the greater Charlotte, North Carolina area. Today I wanted to share my thoughts on a concept that a lot of people talk about, that you're going to see this in any real estate book or real estate program that you buy, and it's how to not pay taxes, right? How how real estate investing can result in no income tax being paid. So, I read about this in probably Rich Dad, Poor Dad, probably a couple other. One of them was Landlording on Autopilot. I don't remember the guy's name, but that was kind of the book I modeled my real estate business after. And I believe he was a police officer or something like that. And, he was renting out what we would call pretty crappy homes. They're nothing all that nice, but there's a market for that, and he was probably renting them out for $400 a month. I would venture to say he probably wasn't making $100,000 a year on his W-2 job, and he was able to claim real estate professional, I'm assuming, and he said really the entire point of doing real estate is to get your income tax from your W-2 job down to zero. Now, Robert Kiyosaki in Rich Dad, Poor Dad, and certainly on the Rich Dad YouTube channel, he talks about it a little bit different. He and Kim Kiyosaki, his wife, he tells a story about how he was with a business partner, and he said his business probably made $300,000 a year, maybe a little bit more, and they had asked Robert and Kim how much they make, and they said 120. And as I recall the conversation, the guy was like, I don't know how you do that, blah, blah. But Robert's like, I don't pay any income tax. So, that 120, I get to keep all of it. And, where my wife and I, we really only have one home right now that isn't rented. It's the duplex. And, it's going to be a lot of work. It's really the bane of my existence right now. But sorry about the camera. We were able to finish up all the other homes and get them all rented, and our business is actually doing very well. It is not struggling. Airbnbs have started to pick back up, and we're starting to actually make some money. And so, of course, when we're making money like that, I'm worried about the tax side. We should have a ton of write-offs for this year, so I'm not all that concerned. But Kim and I are closer and closer to retirement, more so her than I. I think we can replace her income next year. Kind of promised her this year, but things went a little unexpected with the pandemic, and then I would have thought with 44 million people unemployed that the real estate would go up the way it's going up. I mean, it's just crazy. But I was starting to look at the amount of write-offs we need now with W-2 income, right, versus the amount of write-offs we're going to need with when we no longer have W-2 income. So right now with my W-2 income, I'm trying to maximize every write-off I can. I want to buy them cheap. I want to rehab them for $20,000 to $50,000 and be able to write all of that off in a single year. I told Kim we have to, that's still great. If I can find those, let's find those. However, going forward, we need to start buying homes that are more rent ready, right? In our range, say 80, 90,000. Here in Charlotte, you're not finding anything for $80,000, $90,000 right now. But if we can find a good deal on something that maybe needs some flooring and some paint, maybe a little pressure washing or something like that, then we need that longer term depreciation. Maybe the sweet spot is like $5 to $10 grand. Talking like a new roof or a new HVAC system, get it up and running. If we do it properly and we do it correctly, we should be able to write those off in the same year that we purchased the property. But if you're not familiar with your tax return when you're a real estate investor, most people are not. Even most real estate investors, I have a feeling, are not. We file on a Schedule E, which is a passive income. Now I'm able to take let me talk about write-offs a little bit in the history of it. Back in the 80s, the top marginal tax rate was like 90%, but nobody ever paid that because there were so many tax write-offs. back in the early 80s, any doctor or dentist or anybody who was making any amount of money would, they would have rental income. And if you had enough rental properties, at some point you would have enough write-offs, maybe 20 rental properties. And there were CPAs who specialized in this. Your average doctor paid zero income tax. And of course, this really pissed off liberals and, other left-leaning people who think that paying taxes is something that the rich should definitely do. And so Reagan had changed, I believe in 1984, the tax code, dropped the top marginal tax rate down to like 32 or something like that, 35, and they closed all these loopholes. And after that, all these dentists and doctors and professionals dumped all their real estate because they were no longer able to write it off. Imagine if they actually kept it. I mean, geez. Knowing what I know now, that would have been good. However, they did keep a little bit of it in there. So you can write off $25,000 of passive income or passive losses every year against other income sources. In this case, for me, it's a W-2 job or my wife. Now, you can claim something called real estate professional. I'm really not going to go into that, but it's a special election you can take on the Schedule E in which there is no longer a cap. There's no longer that $25,000 cap. And so, that's been our goal every year, is to make sure that we qualify for that. You got to be able to document it, which we do. And, and let's just say hypothetically we're making $150,000 a year. If we could get our taxable income due to Schedule E losses down to $75,000 or $80,000, people who make that much, especially as a couple, they really don't pay much in income tax. And if you can get it down to about $50,000, really, for a couple, you're really not paying much income tax at all. And so that's the goal every year. But that's a goal with a W-2 job. Now, I'm planning forward for retirement, so this is what I've been thinking about recently. And it's like, well, I don't need $50,000 worth of losses every year, because once I no longer have a W-2 income or some kind of Schedule C income to write that off against, that just goes into this bank. There's a bank where you can bank your losses. You don't lose them, you just can't use them. And then let's just say one year something happens, tax planning didn't work properly, and we ended up with a $50,000 profit. Well, we can dig into that bank and zero out that profit. But that's the thing about this business is, and I probably have $30,000 worth of losses banked up. That's not doing me any good right now. I can't use them. I'm sure eventually they will get used. So going forward, once we retire, which hopefully happen in the next couple of years, and I have some strategies for that I'm trying to get prepared for. I don't need losses. I just need everything to be around zero. And even then, I don't even need that because, and I got to go back and look, but the first like $20,000 or $25,000 of profit is tax-free due to the Trump tax changes that he did. So, when I do actually get retired and stuff like that, I'll look into that a little bit more, and that'll become part of our tax planning. But it's just really interesting, and it's something I can actually see now that we're actually starting to approach it. When I first started this 5 years ago, there was no way. I mean, I understood that it could be done. I just couldn't visualize it or see it on a tax return, where now I can. So, anyways, that's my thoughts on the power of real estate investing, especially if you're retired. Pretty sure you don't pay Social Security when you have Schedule E income. But on the same note, if you plan everything right, you shouldn't have any income anyways on paper, even though you're making pretty good income into the bank. So what are your thoughts? Leave them in the comments section below, and I hope you have a fantastic day.